Welcome to the deep dive. We've got a stack of sources here, all about U.S. capital gains rules, and our mission today to really dig in and find those strategic, legal ways to minimize your stock trading tax bill. It's not just about the paperwork, right? It's about smarter moves before you even hit sell.
That's exactly right. The sources lay it out pretty clearly. It's all about understanding the game. You've got short-term gains taxed high and long-term gains where the IRS gives you a break. The goal is to shift from being, passive to actively managing your tax situation. It's about playing the long game the IRS wants you to play.
Okay, let's jump right in. The first big concept seems to be, when does the tax clock actually start? Realized versus unrealized gains. We're talking capital assets here, stocks, bonds, that kind of thing. The sources say a gain or loss only becomes a taxable event when you sell.
That's the absolute key distinction. Let's say you buy a stock for $50. It goes up to $70. That $20 profit is just on paper for now.
Yeah.
It's unrealized. There's no tax due, nothing to report yet.
Hold on. So if I buy Apple today and 20 years from now it's gone up like 1,000%, and I haven't sold a single share, the IRS just ignores it. That seems like an incredibly powerful benefit, almost like a loophole.
It is powerful. It's the power of deferral. And honestly, it's probably the most overlooked advantage of just buying and holding. Think about it. Your gains are compounding year after year, decade after decade, and the tax bill is pushed way out into the future. You're essentially getting an interest-free loan from the government on the taxes you'll eventually owe, letting that money work for you.
Okay, but eventually you might sell. And then you need to calculate the tax. That brings us to cost basis. What exactly is that, and why is tracking it so important?
Your cost basis is basically what you paid for the asset.
Yeah.
Simple as that. But you also add in things like commissions or fees you paid when you bought it, so your adjusted basis. It's critical because tax is only on the profit, the difference between the selling price and your basis. And yeah, tracking it can get a bit messy if you bought shares at different times, different prices.
Right. The sources mentioned a couple of ways to handle that. FIFO and specific identification. Can you break those down? How do they help an investor?
Sure. So think of your shares like boxes in a warehouse. FIFO means first in, first out. That's the default method the IRS assumes you're using if you don't specify otherwise. When you sell, they figure you sold the oldest shares first, the ones you bought way back when. Often, those have the lowest cost basis, meaning a bigger taxable gain for you right now.
Okay, so FIFO might not be the best tax outcome. What's the alternative?
The alternative is specific identification. This lets you choose which specific box or lot of shares you're selling. If you bought shares at $50, then later at $80, and the stock is now $100, you could choose to sell the $80 shares first, realizing only a $20 gain per share, instead of the $50 gain you'd get selling the older ones under FIFO. It gives you real control over the timing and amount of your taxable gains.
That's a fantastic level of control. But let's get to what the sources call the golden rule, the biggest factor, the holding period. Where does the IRS draw that line?
It's a very bright line. Exactly 1 year. That's the magic number. Hold an asset for 1 year or less, sell it, and any gain is short-term. And short-term gains are taxed at your ordinary income tax rate. For folks in higher brackets, that could be, 35%, 37%, pretty steep.
But if you hold that exact same asset for more than 1 year, say 1 year and 1 day,
everything changes. Suddenly, it's a long-term capital gain. And those get preferential treatment, much lower rates, 0%, 15%, or 20%, depending on your overall taxable income.
Okay, this is where it gets really practical for listeners. Let's make it concrete. Same stock, same, say, $5,000 profit, holding it 364 days versus 366 days. That 2-day difference means a radically different tax bill.
Radically different. It could easily mean paying, say, $8,850 in taxes at 37% versus maybe $750 at 15%, or even zero tax if your income is low enough. The tax code is explicitly designed to reward patience. That 1 year and 1 day hurdle is intentional.
Can you give us a rough idea of the income levels for those lower long-term rates in 2025?
Sure. Keep in mind these numbers change, but for 2025, for a single filer, the 0% rate applies up to about $48,000 of taxable income. The 15% bracket goes way up, over $530,000, and only above that very high income level do you hit the 20% rate for long-term gains. The key takeaway is, for many, many people, long-term gains are taxed at 0% or 15%. That gap between 15% and potentially 37% for short-term gains, that's huge. It's the biggest lever you have.
Okay, so holding long-term is crucial. But life isn't always simple. People sell winners and losers during the year.
Yeah.
This brings us to netting. How does the IRS sort out this mix?
Right, netting. It's a specific step-by-step process. Think of it in stages. Stage 1, you lump all your short-term gains and all your short-term losses together. They offset each other first. Calculate your net short-term result. Could be a gain, could be a loss. Stage 2, do the exact same thing for your long-term gains and losses. Calculate your net long-term result.
Okay, so two separate buckets initially. What happens next? Say I have a net short-term gain of $10,000, but a net long-term loss of $4,000.
Now comes stage 3, cross-netting. If one bucket has a gain and the other has a loss, they offset each other. In your example, the $4,000 long-term loss wipes out $4,000 of the short-term gain. So you're only left with a $6,000 taxable short-term gain. The loss provided direct tax relief.
What if it goes the other way? What if, after all that netting, your total losses are bigger than your total gains?
That's where the capital loss deduction kicks in. It's another helpful rule. If you have an overall net capital loss for the year, you can deduct up to $3,000 of that loss against your ordinary income. That's your salary, wages, other income. It directly reduces your taxable income from other sources.
Only $3,000, though. What if I had a really bad year, say a $20,000 net loss? Is the other $17,000 just gone?
Oh, definitely not. That's the beauty of the loss carryover. Any capital loss you couldn't deduct this year, that extra $17,000 in your example gets carried forward to next year and the year after that and the year after that, indefinitely. You can use those carried over losses to offset future capital gains, or keep deducting $3,000 against ordinary income each year until the loss is used up. It turns market volatility, even painful losses, into a persistent tax asset for the future.
That ability to carry over losses leads perfectly into the next strategy. Tax loss harvesting. TLH. This sounds like actively using down markets to your advantage.
It absolutely is. TLH is a well-established, totally legal strategy. It's about intentionally selling investments that are down, realizing a loss specifically to offset realized gains elsewhere in your portfolio. Let's walk through it. Say you sold some winners and have a $25,000 long-term capital gain you're facing taxes on. But you also own another stock or fund that's currently down $30,000 from what you paid. You could strategically sell that loser to realize the $30,000 loss.
Okay, so that $30,000 loss completely wipes out the $25,000 gain. No tax due on that gain. If that gain was going to be taxed at 15%, you just saved yourself $3,750 instantly.
Exactly. Instant tax savings. And you still have $5,000 of loss left over. $30K loss minus $25K gain. Of that $5,000, you can use $3,000 to deduct against your ordinary income this year. And the remaining $2,000, that carries forward to next year. See how powerful that is? You turn a paper loss into real tax alpha.
Very powerful. Now, the sources also mentioned something called the net investment income tax, the NIIT. What is that, and why is it particularly relevant for higher earners doing this kind of harvesting?
Right, the NIIT, it's an additional tax. It's a 3.8% surcharge on investment income, which includes capital gains, interest, dividends. But it only applies above certain high-income thresholds. For example, modified adjusted gross income over $250,000 for those married filing jointly. So it doesn't affect everyone, but for high earners, it changes the math.
How so? If someone's already in the top 20% long-term capital gains bracket,
then the NIIT potentially adds another 3.8% on top of that. So their total federal tax rate on that long-term gain isn't 20%, it's 23.8%, plus state taxes potentially.
Ah, okay. So because their overall tax hit is higher, the value of avoiding that tax through strategies like tax loss harvesting is even greater for them.
Precisely. The higher your marginal tax rate on investment income, the more valuable each dollar of harvested loss becomes. For high net worth individuals, active tax management through TLH isn't just nice to have, it's almost essential for wealth preservation.
Okay, we've hit the big opportunity, that long-term holding period, and a key strategy, TLH. But now we need to discuss the major constraint, the big gotcha when doing tax loss harvesting. The wash sale rule.
Yes, the wash sale rule. Very important.
Yep.
The IRS put this in place to stop people from, well, gaming the system. They don't want you selling a stock just to claim the tax loss, then immediately buying it right back, basically ending up in the same position but with a tax break.
Makes sense. So what's the actual rule? How long do you have to wait?
The rule creates a 61-day window around the sale date. If you sell a security at a loss, you cannot buy back that same security or one that's substantially identical within 30 days before the sale or 30 days after the sale. That's 30 days before the day of sale and 30 days after 61 days total. You need to be out of that position for that period to claim the loss.
Substantially identical sounds a bit vague. What does that usually mean?
It can be tricky. but generally means things like options on the stock, or sometimes even certain ETFs tracking the exact same index very closely. It doesn't usually mean buying a different company in the same sector, though.
Okay, that's the basic rule. But the sources flagged a huge pitfall here, something that causes permanent damage. What happens if this wash sale involves a retirement account, like an IRA?
Ah, yes. This is probably the single most critical and often misunderstood part of the wash sale rule. We really need to emphasize this. Let's say you sell stock X at a loss in your regular taxable brokerage account. Good, you want that tax loss. But then within that 30-day window after the sale, or 30 days before, you buy stock X back inside your IRA or your 401k. If you do that, the loss you realized in the taxable account is disallowed permanently.
Permanently. That sounds much worse than violating the rule just within taxable accounts. Why is it permanent?
It's because of how the accounts work. If you violate the wash sale rule by buying back in another taxable account, the disallowed loss isn't truly lost forever. It gets added to the cost basis of the new shares you bought. So you'll get the tax benefit eventually. When you sell those new shares, the deduction is just postponed. But IRAs and 401ks are different. They're tax advantaged. They don't have a cost basis in the same way that taxable accounts do. There's no mechanism inside the IRA to track and add that disallowed loss. So if the loss is disallowed because you repurchased in an IRA, it just vanishes. There's nowhere for it to go. The tax benefit is gone forever. It's a critical mistake to avoid. You absolutely must track purchases across all your accounts during that 61-day window.
Wow. Okay, that is a massive takeaway. Avoiding that IRA repurchase trap is crucial. Let's shift gears slightly. We've talked about managing taxes on gains. What about avoiding the tax altogether? This brings us to the ultimate shield, tax-advantaged accounts themselves.
Exactly. Using accounts like traditional IRAs, Roth IRAs, 401ks, 403bs, this is a parallel strategy. Instead of managing a tax hit when you sell, you put the investments in an account where the selling itself often doesn't trigger immediate tax, or sometimes any tax at all. These are incredibly powerful for long-term growth, especially for assets you might trade more often or expect high growth from.
Let's quickly differentiate traditional accounts. The benefit is upfront, right?
Generally, yes. With a traditional IRA or 401k, your contributions are often made pre-tax. That lowers your taxable income today. The money grows inside the account tax-deferred. You don't pay taxes year to year on dividends or gains. The catch is, you pay ordinary income tax on withdrawals when you take the money out in retirement.
And the Roth is the mirror image.
Pretty much. With a Roth IRA or Roth 401k, you contribute after-tax dollars, so no upfront tax break. But here's the payoff. All the growth inside the account, decades of compounding, and all your qualified withdrawals in retirement are completely 100% tax-free. The sources rightly point out that having both types of accounts can be really beneficial. It's called tax diversification.
Tax diversification, meaning in retirement, you can choose where to pull money from based on your tax situation that year.
Precisely. Need to keep your taxable income low 1 year. Pull from the Roth. In a year where you have lots of deductions or lower income anyway, maybe pull from the traditional account. It gives you strategic control over your retirement income stream and your tax bracket year by year.
And strategically, where should people place certain types of investments? Does it matter if a high dividend stock is in a Roth versus a traditional versus a taxable account?
It definitely matters for optimization. The general rule of thumb is to place assets that generate the most frequent, highly taxed income thinking, bonds generating interest, REITs, or high turnover mutual funds, constantly spitting out short-term gains inside your tax-deferred accounts, like traditional IRAs, 401ks. This shields that tax-inefficient income. Assets you plan to hold long-term for capital appreciation might be fine in a taxable account to get preferential long-term rates, or potentially ideal for a Roth where all that growth becomes tax-free.
Okay, this is all great strategy, but we have to touch on the practical side, compliance and records. Keeping track of all this seems essential. What forms are involved?
It is absolutely essential. The main forms are IRS Form 8949, where you list the details of every single sale description, date acquired, date sold, proceeds, cost basis. The totals from Form 8949 then flow onto Schedule D, capital gains and losses. And the final net gain or loss from Schedule D goes onto your main Form 1040 tax return. Your broker will send you a Form 1099-B summarizing your transactions, which is helpful.
But the buck stops with the taxpayer, right?
Absolutely. The 1099-B might not always have the correct cost basis, especially for shares held a long time or transferred between brokers. You are ultimately responsible for ensuring the accuracy of your cost basis and holding periods for every single transaction. Meticulous record keeping is non-negotiable.
Okay, we've covered a lot of ground. This deep dive really underscores that tax planning isn't just an afterthought. It's integral to investing. For me, the two absolute biggest takeaways are, number one, the immense power and importance of that 1 year and 1 day holding period. It's the single easiest way to slash your tax bill.
Couldn't agree more. And number two has to be that wash sale rule, specifically the permanent loss pitfall when you repurchase in an IRA within that 61-day window. Avoiding that mistake is paramount. Honestly, just knowing these two rules fundamentally changes how you should approach buying and selling. It moves you from passive to active tax management. And remember, like the sources suggest, sometimes the best returns come not just from what you earn, but from managing what you actually get to keep after taxes.
That's perfectly put, managing what you keep. And that brings us to our final provocative thought, building on something you said earlier about unrealized gains. Our sources hammered home the power of tax deferral gains aren't taxed until you sell. So here's something for you, the listener, to think about. If those huge unrealized gains aren't taxed while you hold them, how might the ability to borrow against that equity, maybe through a low-cost portfolio loan or margin, change the decision? Does accessing liquidity that way potentially become more attractive than selling, realizing the gain, paying the tax just to get cash? Could you, theoretically, defer the tax forever?
That's a fascinating question, touching on liquidity needs versus long-term tax optimization. Definitely something to mull over with the principle of deferral in mind. Thank you for bringing these sources together for this deep dive. Really critical information.
Absolutely. And just a reminder to everyone listening, this discussion is for educational purposes only. It is not professional tax or investment advice. Please consult with qualified professionals for your specific situation. We'll catch you on the next deep dive.